Hello, and welcome back to the channel. I'm Algabot, your guide to the mechanics behind automated trading systems. Today we're taking a close and careful look at an expert advisor for MetaTrader 5 called Volume Shelf Accumulation Bounce. This strategy reads the traded volume profile to find price levels where large, patient participants have quietly built inventory, and it studies the reaction when price returns to those levels. By the end of this video, you'll understand how it maps volume into shelves, how it decides to buy or sell, and how it manages risk. Remember, this is educational information only and not financial advice. Let's begin. So what exactly does this expert advisor do? At its heart, Volume Shelf Accumulation Bounce is a volume profile strategy. It is written to study markets like gold or the US 500 index on the 15-minute time frame, although the time frame is never hard-coded, so it follows whatever chart you attach it to. The central idea is simple to state. Large, well-capitalized participants tend to build and unwind positions quietly, at price levels where they can absorb size without pushing the market around. When they do that, they leave a footprint in the traded volume. On the chart, that footprint shows up as a cluster of adjacent price levels that all carry unusually heavy volume. The strategy calls such a cluster a shelf. To find these shelves, the expert advisor rolls a volume profile over a window of recent closed bars. It slices the price range into a set of equal buckets and adds each bar's tick volume into every bucket its range touches. Buckets that carry a high fraction of the busiest bucket are treated as high-volume nodes, and contiguous high-volume nodes are fused together into a single shelf. Two extra filters keep only the meaningful clusters. A shelf must span a minimum number of buckets, and it must carry a minimum share of the total volume. A shelf that sits below the current price is read as hidden support, where buyers have been defending inventory. A shelf that sits above price is read as hidden supply. The strategy keeps the nearest of each and waits. Who is this style suited to? It is aimed at traders who think in terms of market structure and resting liquidity rather than fast momentum, and who want to study how volume clustering can define support and resistance. As always, this breakdown is for education only. Let's walk through the decision process exactly as the code runs it. First, the expert advisor acts only once per bar on a freshly closed candle, so it isn't reacting to every tick. Before it considers anything, it checks three housekeeping rules. There must be enough history to build the profile and warm up the average true range. There must be no position already open under its magic number, and the current spread must sit below the spread cap. If any of those fail, it simply waits. Next comes the analysis. The strategy builds the rolling volume profile, applies the high-volume node cut, and clusters the survivors into shelves. From all the qualifying shelves, it keeps just two: the nearest support shelf whose center sits below the closing price, and the nearest resistance shelf whose center sits above it. Now the entry logic. For a long, three conditions must all be true on the just closed bar. The bar's low must dip into the support shelf zone, coming within a tolerance measured in average true range units of the shelf top. The close must finish back above the shelf top, showing the level held. And the bar must be bullish, closing above its open. When all three line up, the strategy reads this as buyers defending their inventory, and it signals a buy. The short side mirrors this. The bar's high must push up into the resistance shelf zone, within tolerance of the shelf bottom. The close must finish back below the shelf bottom, showing supply held. And the bar must be bearish, closing below its open. That combination signals a sell. Risk management is tied directly to the shelf. For a long, the stop loss is placed an average true range buffer below the far, lower edge of the support shelf, because a clean break all the way through the shelf would invalidate the idea. For a short, the stop sits the same buffer above the resistance shelf. The take profit is then set at the reward ratio, by default 2, multiplied by that measured risk. Position size is a fixed lot value, and only one trade runs at a time. Let's look at the actual MetaTrader 5 code on screen. At the top are the input parameters you can adjust in the strategy tester. ProfileBars sets how many closed bars form the rolling volume profile, and Bins sets how many buckets the price range is sliced into. The HvnThreshold is the percentage of the busiest bucket a level must clear to count as a high-volume node. MinShelf Bins and MinShelfShare are the twin quality filters, controlling the minimum width and the minimum volume share of a valid shelf. TouchATR multiple is how close the probe must come. SlATR multiple is the stop buffer, and reward ratio scales the take profit. Below the inputs is the long block. You can see the long signal is true only when we have a support shelf. The closed low reaches within tolerance of the shelf top. The close finishes above that shelf top, and the close is above the open. When that holds, the code reads the ask price, sets the stop and average true range buffer below the shelf base, computes the take profit as the reward ratio times the risk, and calls trade.buy. The short block is the mirror image. The short signal is true when we have a resistance shelf. The closed high reaches into the shelf zone. The close finishes below the shelf bottom, and the close is below the open. The code then reads the bid, places the stop above the shelf top, sets a symmetric take profit, and calls trade.sell. Both sides are fully defined, so the strategy is neutral to direction. Let's bring the whole idea together on this illustration. On screen, you can see a candlestick chart with two shaded bands. The green band in the lower half is a support shelf, a cluster of high-volume price levels where buyers have been quietly defending inventory. The red band in the upper half is a resistance shelf, where supply is resting. These bands are what the volume profile produced. Watch how the strategy interacts with them. On the opening candles, price is trading in the open space above the support shelf and drifting lower. Each candle steps down toward the green band, and you can see the selling pressure easing as it approaches that heavy volume zone. This is exactly the region the strategy has been watching, because concentrated resting liquidity tends to absorb incoming flow. Now look at the signal candle. Price dips its low right into the support shelf, piercing into the green band. But by the time the candle closes, it has recovered and finished back above the shelf top, and it closes above its open, a bullish reaction. That is the precise combination the strategy requires: a probe into the shelf, a close back on the defended side, and a bullish bar. The buy entry marker appears here. The stop loss is tucked just beneath the lower edge of the support shelf, because if price sliced all the way through that band, the whole idea of hidden support would be wrong. From there, price springs away from the shelf. The next candles build a steady rise, each one closing higher, as the absorbed selling gives way to buyers. Price travels up through the open space, and the move reaches the take profit target, marked here, at a distance of 2 times the risk that was set at entry. That is the reward-to-risk ratio of 2 in action. The long trade is complete. Now the second half of the story. Price keeps pressing higher and approaches the red resistance shelf near the top of the chart. Watch this candle. It pushes its high up into the red band, testing the resting supply. But it cannot hold there. By the close, price has been rejected back below the shelf base, and the candle closes below its open, a bearish reaction. This is the mirror image of the long setup, and the sell entry marker appears here. The stop loss for this trade sits just above the upper edge of the resistance shelf, above the resting supply. Once the rejection is confirmed, price rolls over and works its way down. Candle by candle, it slides back through the open space it had climbed, closing lower each time as supply overwhelms the buyers who chase the highs. The decline carries price all the way to the short take profit target, again set at 2 times the measured risk. The second target marker confirms the level is reached, and the short trade is done. Step back and notice the symmetry. In both trades, the strategy did the same thing. It waited for price to probe a high-volume shelf. It required price to close back on the defended side with a matching candle, and it placed its stop just beyond the shelf where the thesis would break. It never chased price in open space. It only acted at the shelves the volume profile had already marked as important. Of course, not every probe holds, and price can and does break straight through these shelves, which is why the stop loss beyond the far edge is central to the design. This is an illustration of the logic, not a prediction of what any live market will do. Let's wrap up. Today we explored the Volume Shelf Accumulation Bounce Expert Advisor for MetaTrader 5. We saw how it builds a rolling volume profile, how it clusters heavy volume price levels into support and resistance shelves, and how it looks to buy when a support shelf is defended and sell when a resistance shelf rejects, with the stop loss placed beyond the shelf and the take profit set as a multiple of the risk. Everything here was shared for educational purposes only, and none of it is financial advice or a recommendation to trade. Trading carries real risk, and losses are a normal part of it. If you found this breakdown helpful, please like the video, leave a comment with the strategy you'd like analyzed next, and subscribe for more MetaTrader 5 strategy studies. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.